Most traders lose money not because they lack strategy, but because they can't read the market's true direction. They chase signals, jump on indicators, and still end up on the wrong side of the move. The real secret? Trend is everything. If you can't identify the trend, you're just guessing. In this video, I'll show you exactly how to read the market like a pro, using real price action, chart structure, and smart money concepts. By the end, you'll know how to spot real trends, avoid fake moves, and trade with confidence. Let's get started. This chart is a powerful example of how trends evolve in the market and how traders can read them using both price action and momentum indicators. At first glance, we see three distinct phases separated by large white arrows. The left side of the chart begins with a strong bullish trend. Candlesticks are forming higher highs and higher lows, indicating clear upward momentum. At the bottom, a green histogram labeled "The Start of Positive Trend" confirms this move. As the histogram grows taller, it signals increasing bullish strength. This is a textbook setup where smart traders look to enter long positions on pullbacks or bullish continuation signals. The market is trending cleanly, and everything, price action and indicator, aligns in favor of buyers. As we move to the middle of the chart, the direction completely shifts. The white arrow points sharply downward, and the structure breaks. Now we see a series of lower highs and lower lows forming, a clear bearish trend. The momentum indicator below turns red and begins to grow downward, with the label "The Start of Negative Trend." This shift is a classic example of a trend reversal. For traders watching closely, this is a signal to stop buying and begin looking for sell entries in line with the new downtrend. The red histogram confirms bearish momentum is growing, and entries on pullbacks to previous support levels turning into resistance would be ideal in this phase. Moving toward the right side of the chart, we see a return to bullish momentum. Candlesticks again form higher highs and higher lows, and the white arrow turns upward. The histogram also shifts back to green with the label "The Start of Positive Trend." This signals another opportunity for buyers to take control of the market. The trend has reestablished and momentum is again favoring the bulls. However, in the final portion of the chart, the top right area, we notice the green histogram starting to shrink. This is a subtle yet important signal that bullish momentum is weakening. The price action also shows signs of slowing, possibly moving into a consolidation zone or a distribution phase before another reversal or pullback. This entire image showcases the importance of aligning price action with momentum. By studying structure, like higher highs and lower lows, and confirming with a trend strength indicator, traders can avoid confusion, reduce losses, and trade with much higher confidence. It teaches a valuable lesson. Don't trade blindly. Wait for confirmation, follow the trend, and pay attention to when that trend begins to fade. This chart represents a classic example of trendline trading and breakout analysis, showcasing how the market reacts when a strong trend line is broken. On the left side of the chart, we observe a steady uptrend, where the price consistently forms higher highs and higher lows. This upward structure is supported by a clearly drawn blue trend line, which acts as a dynamic support level. As long as the price respects this trend line, traders can confidently assume the bullish trend is intact and look for buy entries on pullbacks to the line. However, as the market progresses to the middle of the chart, price action starts to lose momentum. We notice that the highs are not pushing much higher, and the candles begin to close closer to the trend line, a potential warning sign of weakening strength. Eventually, we reach a critical moment, the trend line breakout, which is marked with a red arrow and labeled on the chart. Here, price breaks below the trend line with a strong bearish candle, closing firmly beneath the line. This moment is significant. It signals a shift in market sentiment from bullish to bearish. Once the trend line is broken, it is no longer acting as support. Instead, it often becomes resistance, and many traders anticipate a pullback toward the line to confirm the breakout before entering short positions. In this image, after the breakout, price continues to fall sharply, forming lower lows and confirming the new downtrend. This move illustrates how a simple trend line, when used correctly, can help traders identify trend reversals with clarity. This type of setup is highly useful in real trading conditions. The trend line gives a visual boundary of trend strength, and the breakout provides a clear signal to reevaluate your bias. For bullish traders holding positions at this point, the trend line break would be a strong exit signal. For smart bearish traders, it becomes an ideal entry setup for selling with the new momentum. This chart perfectly illustrates a strong uptrend using price action and a clearly drawn trend line. Visually, we can see that the market is making a consistent series of higher highs and higher lows, which is the defining structure of an uptrend. The black ascending trend line is drawn by connecting the major swing lows, the points where price pulls back and then bounces upward. These points are highlighted with green circles, showing how the price touches the trend line multiple times and respects it as a dynamic support zone. Each time the price pulls back to the trend line, it finds buying interest, resulting in another move higher. This is a strong confirmation that the buyers are in control of the market, and the trend line acts as both a psychological and technical support area. Traders often use this kind of setup to enter buy positions on pullbacks, placing stop-loss orders just below the trend line or the recent swing low for protection. As the trend progresses, the pullbacks become slightly deeper, but the overall direction remains upward. This shows healthy trend behavior, where the market breathes but doesn't break structure. Even when red candles appear, representing temporary selling, they are followed by strong green candles, showing that buyers are stepping back in at higher prices. Toward the right side of the chart, we notice the price begins to approach the trend line again, but this time with weaker momentum. While it hasn't broken the trend line yet, this could be an early signal of trend exhaustion. However, until the trend line is decisively broken and lower highs-lows form, the uptrend is considered intact. This image is a textbook demonstration of how to visually identify and trade a trend using a trend line. It teaches a crucial trading principle. As long as price respects the trend line and continues to form higher lows, the trend remains bullish. For traders, this kind of setup offers low-risk, high-reward entry opportunities when trading in the direction of the prevailing trend.